the rotation from the S&P to the Nasdaq,
Oh, okay.
and that's a key reversal as I'm seeing on a daily chart. It's come right back down to the 2000 low. We'll see if it does it by Friday, but who knows? There's immense divergence on the RSI, and if it also does it against the gold, then I get troubled for the Nasdaq. Now it may just be a rotation, but normally I'm equally looking at the spike on the volatility on the Nasdaq against the VIX, the VNQ against the VIX, and it's spiking badly. That normally is stress. Now I get it that we're monetizing the balance sheet.
Yep.
So it's not 2000, it's 2020. I'll get more concerned about the stress if the dollar strengthens. Otherwise, I'll rotate just to be long the S&P and just short the Nasdaq as a pair trade.
Yeah. Well, you know what? Okay. So first of all, let me stop you for 1 second. Whatever Mr. Green's work was, I'm not part of it. You know, I learned as much like you did from him and others. So I am certainly not an expert in any way, shape, or form. And on a good day, I'm merely a mediocre technician with knowledge of certain facets, but I'm a mediocre. By my own admittance, I'm a mediocre technician in that realm. Now, it's not my strength. It's not what I go running to. I certainly respect it, and why I'm sitting here and listening. And Judd teaches me just like other people teach me. So I'm not. That's not false humility. That's just the reality of my situation, because I'm so immersed in the fundamentals of the market that that's why I paid, way a lot of money for that service, because it saved me mega amounts of time that I would not have had to delve into the fundamentals in the in-depth way that I do. So I just want to correct any misperception. So my strength in looking at this with the vols, and Judd sent them to me, is, I don't know what to make of it. I'm not a vol watcher. When I do watch vol, Andrew, it's when vols get too low for too long, because that's a trading strategy, as you probably well as know as anybody, with the risk parity crowd and others who really pushed that until they got punished enough in February, March, and April of this year, where the costs were horrendous, because it's a great strategy until it starts to go against you, and then you have to raise capital to meet your variation margins and everything else that goes with it, and you saw them blow up. And I think that was more an issue, that they were stressed to raise the capital to keep them into place. That's my opinion on it, because that much I understand about the vols. I think it's a miserable strategy, except that when it's one of those that when it works 9 out of 10 times, people love it, except when the 10 time blows up the whole, as we saw this year. So, I'm not sure what to make of the vols. I can only fit it in when you get to the discussion about the dollar. Now we can have a deep discussion, because I've spent the last, I don't know, certainly 2 months delving into this and building a viewpoint. And for the last 48 hours, been very immersed in it, because now we've got actually some breakout levels. And now the euro, which has been a little bit all over the board today, although I have to, we're still not out of the woods there, because this weekend, Friday and Saturday, we have the European Commission, who has to sign off on what Lagarde in her calls now the RRF, which is that massive fund, and how it will be distributed, which I think is critical. It's been what I've based my pivot on the euro, going back again to May 24th, 25th, to become bullish. But technically, in my rudimentary technical abilities, we are certainly at some critical junctures here, and that's where the dollar. Now, I happen to be very bearish the dollar, because the dollar is, to me, a barometer of Fed success. If the dollar were to rally, the Fed would be an abject failure in its efforts to accomplish whatever it wants to accomplish. Now, people,
All right, can I just butt in
sure.
there?
Mm-hmm.
I think that's an immensely important point, because I'm also, and again, back to the volatility question you raised, I'm not a vol trader. I mean, I'm a directional guy.
Yeah.
And I was trained by Howard technically, but I'm a top-down guy technically. I think that I'm looking at something this week as a shape. If the dollar continues to weaken, the Fed has succeeded, and we'll see it through the dollar weakening and the reflating trade. I mean, one of my biggest positions is long gold, short the yuan, because
Mm-hmm.
it's making higher highs every day.
As we say in your country, good on you, because that's been a great trade. So yes. So
It has, but
yeah.
all I'm saying is I'm watching something this week. I was saying to Judd earlier, if the dollar continues to weaken, it's a rotation trade. If the dollar turns, for whatever reason, because none of us know, all we're doing is planning and shaping.
Yep.
We need to then adjust. And I am looking at something that it's different to 2000, because the monetization is immensely different. And I'm seeing no signs in the dollar weakening. So in essence, it looks like more rotation than a deflation. But again, why aren't the bond yields pulling back? Now, maybe that's because it's pegged. Who knows?
Yeah.
But I'm just posing a debate. All right.
It's Andrew, it's amazing. Everybody's going to focus on the bonds, okay? Lacey Hunt from Hosington, who I have great respect for.
I love him. He's a deflationist.
Yeah, he's a deflation, and I'm honored to say, because I've done a podcast or two with him of late, and I've actually engaged with him.
I've listened to both of them.
yeah, so we've had some great off conversations, and I don't get to his deflation camp, because I sense what the Fed, even though he does, but he draws a different conclusion, and I have ultimate respect for him because he's an Austrian, and I certainly place myself in that camp, although he probably says he's an Austrian Keynesian, and that's probably right if you want to put a label on it, as where I find myself as a Marxist Austrian Keynesian, because they each bring something good to the table, and I can take a lot out of there. Okay, so, but if the dollar were to strengthen, then he would be right. Okay, and I think this is where we can go with this conversation. Then he would be right, and that has been my point since February and March, when I was actually blogging about it and said, "Hey, the Fed's got to cut interest rates 0.5%, because this is not a financial issue. This is an economic." When this first started, and people, I locked up with a few people. No, you can't cut rates. You got to cut rates, and then of course they went to zero, but. Throughout this whole time, and this is the difference, and this is why I think the dollar is going to go much lower. This is not a trade issue. See, everybody wants to attach the dollar from the trade point. And that's where I locked up with Trump when 2 months ago he said, well, a strong dollar. I go, you can't be more mistaken. This is when you need a weak dollar, because this is the dollar in its coveted role as the financial backbone of the global system. So if you had a rising dollar, and listen, you're in Australia, they certainly know all about it, because Asia was suffering under a strengthening dollar, because all of those Southeast Asian corporates who were borrowed in dollars. That's where the dollar shortage came from. By the BIS numbers, there was 11 trillion to 12 trillion of non-government dollar-denominated debt in the emerging market world. Well, that had to be financed. And that was where the demand for dollars, especially there was a demand for dollars as the global economy was shrinking dramatically with the lockdown. So when I said a 0.5% cut, I also said they need to open up swap lines to everybody. People laughed at that too, but of course, I have to say they went right, they exceeded whatever I thought, although they could have opened up swap lines to China and Russia. I think that would have been a smarter venue, but I understand the politics of it. So, okay, that wasn't going to happen. But they made dollars accessible. But then the dollars got paid off in June. And the swap lines are not being sucked up at this point, which tells me that there's enough dollars right now in the global system, which is a good thing. But the dollar really needs to drop for the benefit of the global system, because it's a dollar standard, whether you like it or not. So you need a lower dollar for a financing purpose. This has nothing to do with trade, and people who are looking at through the prism of trade, I think are making a huge, huge mistake. Now, in my rudimentary technical work, I call it the beloved Aussie dollar. And wow, that's a pretty nice inverse head and shoulders on the daily chart. It looks to me like that we're going to see what you're calling the rotation, Andrew. And I think the global system needs it. And Judd will tell you that I think, where's the euro going? I think the euro is going to go back and test that 125 area, which some people say, oh, wow, what a move. That's a nothing move. That's the 200-month moving average. It's really inconsequential. That's how stable we've been over that huge duration of time. So we can go back to 125, maybe 130. It's like I locked up with somebody in the FT a couple of days ago when they were telling me, oh, the euro's got all these problems. I said, what problems do they have that they didn't have in 2008 when the euro was at 1.60, right?
Well, but also it's a relative problem, right?
Yeah, exactly. It's a relative, exactly. And I think if you listen to Lagarde this morning, and the big issue was, right now the world's not suffering under the pretense that the euro is an existential issue. Now, it might be in 6 months. It might be at the end of this weekend, but it's not what the world is seeing. And you could see it by the sustained compression in the European sovereign debt market.
So can I ask, look,
Sure.
Anyone who's listening to this conversation, I want to make it very clear. This man took me down to the CME floor. I'm not a technician, but I immense regard for Ira Harris. But I do want to ask you a question, Ira.
Yeah.
If we get a key reversal on the S&P against the Nasdaq on Friday,
yeah,
with immense divergence,
yeah,
so the leadership is failing. If the gold reverses against the Nasdaq,
yeah,
and in the next 2 or 3 weeks, the euro's at 110,
yeah.
Would you change your view from?
Andrew, it would force. Now I'll be out of my positions. I may not have gone long the dollar. I'll be out long before that because I have a nice pivot at what I've been using at the.
That's all. It's the only question I'm asking to the forum. That's all. It must be observed, in my view.
Andrew, I'm a trader. I think like a long.
I know you are. You're one of the best.
As you know, as long as you've known me, I think as a long-term investor, but I make my living trading. And now that as people have tried to explain to me, it's the surest path to the insane asylum, but that's how I've operated. And yeah, I have to suffer it. There's a question here. Classic, I'll give you a run right now. I've been waiting for 2.5 days to buy the copper. And I didn't know that Langer had that, but when I did my technical work last night before I went to bed, I came up with as 284.55 as a nice area where it should hold where the copper should have held. So I put my order in last night at 284.75.
Nice. It's
Right?
also on the sheets.
Yeah, you know, but that's the last place. So when did I look at it this morning? But I got filled, and of course, you know, when the S&Ps were stumbling around, I go, oh, they've been so correlated. So I wound up getting out of the copper. I made a nice play. I have no regrets about it. But that's the trader versus, you know, the more longer term investor. It is interesting, Andrew, and I'm going to pick up what you talk about. Is I will trade stocks with a top down, your words, because that's the way anybody who's in global macro really proceeds top down. And I'll do my top down analysis and find my way to stocks. It's like right now I've been on for 3 weeks. All I've been buying is mining stocks and agricultural stocks. Now I'm waiting for this place.
Can I ask you a question on that? Because
Sure. Yep.
Because I was so frustrated watching the JP numbers and the Goldman Sachs numbers, and watching their trading numbers. You know, I ran some of the biggest banks back in the day.
Yeah, I know.
So you know, these guys were bailed out by the Fed, right? They right.
Yeah.
And you know, it made me sick when I watched their numbers. So they buy another house in Nantucket. So, I kind of say to myself, why don't I just be long gold and gold miners,
yeah,
and go to bed? Now, the reason I don't do that is because I worry about the deflation. Now, I know gold will win in both camps, but it won't win in the same time frame. Because Paul Jones always said to me, you must trade in the time frame in your investment theory, right? So, so the obvious trade is just to be long gold and go to the beach because they've gone mad. How do you protect against that?
Okay, so again, and you know, I go back to Paul in 86, 87 when I actually managed his personal money, and that was like the worst business decision I ever made because he kept trying to grow me, and I said, Paul, I can't trade that big. I can only begin to tell you that conversation, and believe me, it's a real conversation we had because I did really well for him. But I said, I can't trade that big. That's when he did Tudor Select and raised $100 million through Merrill Lynch and wanted to give me 10 million more. I can't trade that big. How, you know, that would have taken me up to about 20 million. It was 1986. I can't.
Wow, it's amazing.
What a stupid ass decision. Baldwin.
I think you're done, okay.
Baldwin, to his regret, took the money because he was trying to move off the floor. I had already really was doing the brunt of my trading off the floor and used the floor only as a repository of great energy and filling orders and just, you know, I love the energy levels. That was just great. So put that aside. So Paul's right. But as a trader, and I said this to Judd yesterday, I know you weren't on yesterday, but we were having this discussion. Because as I'm looking around, okay, one of the key underlying issues, and I was surprised nobody asked Lagarde the question today, being that she's the past director of the IMF. There's a lot of discussion that the IMF needs to raise capital, right? Well, it boggles my mind that they don't embark upon some gold sales again, because now that gold's up at $1,800. They're sitting on a honeypot of money. Now, I know that there are certain restrictions under the covenants of the IMF, but they have embarked on gold sales. In fact, let me tell you about that gold yuan, and Judd will verify this. If we go back to November of 2009, I think that was the last official IMF gold sale. I think it was November 2nd, 2009. The IMF sold 200 tons of gold the Indian government.
Yep.
Okay. Now,
wow.
I was on the treadmill at Lifetime in Old Orchard, and I was long a pretty sizable gold position. And I saw Maria Bartiromo reported out as I'm on the treadmill, and I go, oh, fuck. And the time I got home, I got off the treadmill, got in the car. I go, okay, let me go. Gold had broken $30, probably down to about 1047, 1048. What intrigued me about that, because I had heard rumors of it, and usually, and I'll tell you what, gold sales are ultimately bullish, because really what it reflects is global demand.
Mhm.
So but the Chinese wanted to buy that 200. They were really upset about it because the fact that it was sold to the Indian central bank. Now, I've sat and calculated from that day on where gold was in terms of the yuan. And I believe it was like, and this is a key level, support level for me in the gold throughout this whole thing. And it violated, but I think it was 7,250 yuan to an ounce of gold in November of, I'm not looking at the charts, Judd, so you're
All
doing
right,
them.
you're looking at, I put up a semi-annual, okay?
November, no, go to monthly. I think it'll show it very raw.
Okay, hang on. Let me just slide back these two charts.
Andrew, I'm building this out for you, so bear with me.
No, I'm with you.
All right.
Ira, no, I'm a patient man. I worked with Howard for many years, so it's fun.
All right, there it is. I got that up. Hang on
Okay.
1 second. Let me get the right time frame and
Yeah, I mean, if you really took some time to scroll back to a daily, you'll see it. I'm pretty sure it was November 2nd. I might be off a day or two, but not too much. Because believe me, it caused me a lot of pain, and I did some stupid things. How unusual.
okay, there it is right there. Now I got them both up.
Okay. All right. So you see what I'm talking about.
Yeah, I can. Yeah.
Okay. So that has always been a support level. And we went through there at some point when the gold was correcting. I think, during that big correction mode, and the yuan was actually rallying. So we did get through there. But that level on a monthly basis has held as good as could be. And it told me that's where the Chinese would be very interested, in the Chinese authorities would be massively interested in buying gold. They were really upset with the IMF because they felt that they had been going around. So that's a critical price point. We're nowhere near there. So hold on. I know I always have gold yuan up in my boxes. Thank you, Stanley. And I use it as gold. I use the nearby future times IUSD CNY.
That's what's up.
Right? So now we're at 1,264. I'm sorry. Yeah. No, 12,649 yuan. So and it's had a huge move this year, as we know.
Yeah.
But I just find relationships like that fascinating. Now,
You find them.
I'm anticipating, and I know I'm way ahead of myself here. And let me pull something else out for you, Andrew, which you will read for us. Okay, I have it right here in my hands. But I am waiting for the IMF to do something because they are really being pushed. Some people are saying that they just should print more SDRs. Well, that's fine. I'm all in favor of it. But are you going to back the SDRs 20% with gold, which is what they should do? I mean, if I ran the IMF, and I believe I'm capable.
Ari, can you repeat that again? You're saying they're going to back it by 20% by gold?
Well, that's what they should do if they do a big SDR creation.
Right.
Okay, because right now it's only backed by the underlying. It's like a capital key, like the ECB has, because the SDRs are backed by a basket of currency of IMF of the more high level members. That's all the SDRs are. So
Okay.
but there's a limit on how much they let them create. I've never understood, and I've locked up with some very high level IMF people over the years about this. I said, I've never understood why a group of Keynesians who basically are, because the IMF is one of the great make work programs. This will get me in trouble with all the economists yet again. No.
Yeah, I know. It's just Go ahead. Sorry.
Carl Weinberg, who I talked to a couple months ago, he called me out of the blue. Oh, about when the oil cratered. He called. I hadn't talked to him in years, but Carl called me and said, and Carl got really pissed at me because I was poking at the IMF, and Carl. I don't know how many of you know of him, but Carl Weinberg is a very good economist, and he started out like most PhDs at the IMF because it's a great make work program. And he hates when I say that. Believe me, if he was listening to this, he would jump through the mic and get on me. But, you know, I'm just as flip as I am. I try not to be, but I'm 67 years old. I'm not stopping myself now. So it's a program. But they're Keynesians. Why in their right minds would they hold on to gold? Because we know from the Keynesian viewpoint that gold is, what is gold? Gold is a barbarous relic.
Well, no, it's not when the market's negative rates.
Well, yes, of course, but it's always for the Keynesians. Because listen, you listen to Buffett talk about gold. They don't want to give it its assigned role, which is.
No, I'm not going to let you off the hook on that one. So, I've heard you respect Lacey Hunt, right? So he has a different view to you. He's a deflationist. His view is, and this is why I'm very focused on this key reversal at the moment. So, and I know you're a trader and you've been an immensely successful person. I've known you for years, or from afar, but Lacey Hunt has a different view. Would you agree that?
Oh yeah, absolutely.
Rates go to flat to negative, and the dollar strengthens, and the system will all they're doing is borrowing from future GDP by what they're doing.
Listen, that's right. And Bernard Connolly, I don't know if you know Bernard, but Bernard, and he's such a great analyst. He's probably the smartest global macro person I've ever come across. And I'm doing a podcast with him next Wednesday.
Yeah, you told us about that. I'm really looking forward to that.
And he's got that new book coming out. But that's the study of intertemporal misallocation or dislocation, which is that's where Lacey's and when Lacey had this conversation, he was, and I told him, I said, well, I really have learned quite a bit about this from Bernard, and he was very impressed by that. I said, you don't have to be impressed. I'm far more impressed by what rolls off your tongue. But when you live in a fiat currency world in which you live on a debt-based system, when you keep bringing forward the demand, you lock into this slowdown. And that was my point when I would argue about the Phillips curve. I know we're going all over the place here, but as long as you keep me going, Andrew, let's have it out. So for the Phillips curve, that's what they don't take into account, because if I'm a corporation and I know we keep bringing demand forward, why am I going to invest in capital expenditure when the future is always so uncertain, because we just keep bringing demand forward and demand forward? So it's easier, especially in the United States economy, it's easier to hire people because I can get rid of them. And nothing proved the case more than February, March, and April of this year, when U.S. businesses severed, had they been saddled with capital investment, they would have been in worse shape. But they were able to cut the workers, and then the government, the U.S. Treasury, picked up the slack for them. So that proved to be a winning formula, and that's, to me, why unemployment in the U.S. was resting at 3.5%, because you keep, and I think Lacey would absolutely agree with this, because you keep bringing demand forward. Why? Because everybody lives on credit. We're all borrowed up to the max.
Ira, Lacey's view still is that debt is bad.
Is what?
Now, Lacey's view remains, and correct me if my interpretation is incorrect, but because I think he's one of the best monetarists.
I agree. For 40 years. I've been reading him for 40 years, so yes.
In anyone listening to this, I mean, just Google him and just listen. Him and Gary Schilling have got it right. So you follow the people that have got it right. And Lacey, he's an exceptionally slow speaker, and he's so distinguished. And you got to re-listen to him 3 times because his knowledge of the plumbing is off the charts.
Yes.
And he's so convinced that unless the Fed goes over jumps the shark and actually buys physical equities, and he, as far as I know, is not convinced that it's occurred. He doesn't believe it's gone. His view is if it does that we all got to buy tomatoes, get farms, and dig holes and buy guns.
Right.
My understanding that he's still in the deflationary camp. Now, the Fed certainly has tested the waters with what they've done recently, but he still doesn't believe that's actually buying. He still thinks velocity is going down. That's his view.
Yeah.
Would you agree with that?
I 100%, because he is heavily immersed in the Austrian school, as am I, which is why I always started reading them, because I was lucky enough to have professors in graduate school who were Marxists as well as Austrians and taught me phenomenal about, and I agree with Lacey. That's where all crises start with debt. And now rolling in it. So we're nowhere to get out of it, but he thinks that it leads to deflation. My view about the metals, because I've had the lockup with the CNBC crowd many times on here, and especially when I used to do regulars besides Santelli, and they were gold and inflation. I said, no, gold is a hedge against central banks losing credibility.
I agree with that.
And where Lacey goes, he thinks that the amount of debt is just going to will basically crush the system. You'll come out from under it, but you have to start restructuring it, writing it down, to free it up rather than just keep financing it. But my sense, and this is where I've differed, and this is Bernanke, because if you read enough Bernanke,
portfolio balance theory, yeah.
Yeah, I call him a 37er. I have from the time he's been.
I call him a fuckwit, go on.
Because his research work was that the Fed had made a categorical mistake. The Fed and the Treasury in 1936 and 37 tightened too quick, and they went for a balanced budget too quick, and it crushed the economy. So everything that they could do, deflation is their boogeyman. That's the boogeyman of the Princeton schools. Right? I'll label it. It's a false label because it doesn't really, but just because Bernanke and that.
Hey,
so they will.
Hold on. Let me excuse you guys for a second. Anybody that's trading, pay attention to what's going on here with Amazon and Google on the weeklies. They're trying to run the stocks. Go ahead.
Okay. So why I say that is because their whole view of life is to defeat deflation. They don't worry about inflation. Paul Volcker taught central bankers that you can crush inflation by squeezing money and credit so tight. And he's right. Deflation, as Krugman, and when Krugman sticks to his knitting as an economist, I think Paul Krugman is a very good economist, because if you read his books about Japan in the 90s, taught me a lot. Paul Krugman was, he just got too political, because as I tongue-in-cheek say, is, whenever you would try to excuse me for all the women on here, but my experience of life is whenever you wanted to get laid in academia, you moved to the left. So, his platform at the New York Times moved him to the left in a very open fashion. So I again, that's my flip side. I apologize, but that's just the way. So they will do anything to fight and combat deflation, and that's my point. And I think that Lacey would say they won't succeed because And that's where Andrew, I think you're 100% right in your reading of them.
But Ira, can I just interject there? I mean,
Yeah.
Now, there's no question we're another inflection point now. But when I look back at the challenge that Lacey Hunt may have had, as he's a bond, he runs one bond fund, right? And him and Schilling have seen rates go from 12% to now negative, which is
right.
Extraordinary. And he still stands today. Now, go back 2 years, those 30 years or 10 years, kick back in higher rates and contested their view many times, and must have tested their view. And they have been 100% right.
Yep.
All the way through all the extraordinary monetary policies that all, not just the BOJ, everyone has done, including the stuff that the SMB is doing, cleansing their reserves through buying stocks. And the yields still have gone down. So why now is he wrong?
Well, you know what? But again, yes, that path I agreed with. But if you accept that the banks will go to all extremes, we don't know any limits. And I think we're I have not traded treasuries because I trade a lot of yield curve, and I openly wrote about it and talked about it in this room with White Wave, that I really have not traded treasuries since Lael Brainerd, 10, 11, 12 weeks ago, brought forth the Fed really getting involved on the yield curve, yield curve control. I said, there's just nothing here. I'm not going to fight with him. And I got out that Sunday night. She talked about it over the weekend. And I really, for the most part, except last week, I made a faux pas and got involved in it for a minute and had to remind myself, why not? But my next view, rather than yield curve control, is they go negative interest rates. Because what the Fed is concerned right now, and Lacey, I absolutely agree, and he writes about it, is the huge jump in savings.
Yeah.
Right? That's if you have any Keynesian basis to you at all, that paradox of thrift that Keynes wrote copiously about, this is a real plague upon their desires. So they have to, I think they have to go to negative interest rates. And if you're going to go 10 basis points negative, like the BOJ ain't going to do it, especially when you're the world's reserve currency, you may as well jump over everybody and even jump over the Swiss and go to negative 1% right off the bat. And then at least you'll get some velocity to that money, right? But he's not betting on that. He thinks that velocity keeps declining. But my bet is the Fed is going to panic because, again, they want to halt the threat of deflation. And that brings us back to the dollar. Because if the dollar rallies, Andrew, I'm 100% agreement with you. And I've said it many times in the blog, we will get into a deflationary spiral and the Fed is an abject failure. And then where do we go?
Well, no, look, I connected with your blog many long before this, as you know. As you know, I'm a currency trader from way back, but
I know.
In currencies, ultimately, in the last 3 or 4 years, are just a waste of your money. There's no vol. But I would argue currencies will be the ultimate valve, because everyone's cornered and they're all fucked. But I kind of do you not think that's the ultimate asset class that will resolve everything? Currencies.
Wait, say that again. I missed that.
That is that the currencies will be the ultimate, because ultimately, we can have this place of control as we are, you know, let's sensibly devout, you know, there's a rotation going. It's all nice and all kind, and we reflate the problem. But the problem is clear. They fucked it up, right? They didn't let capitalism work. So they're trying to land this, and they can't. So do you think the ultimate asset class that you need as a trader will be back to currencies? Do you think currencies will become the you know, where it was back in the 80s and 70s, where it flew around big time?
Yeah, you know what? It's a good question. Will, you know, again, because, you know, what makes currency trading so difficult is the amount of variables. And you know that as well as I possibly do, because there are so many things that go in, because it's all a relative trade. Everything in a currency world, unless you fix them, and we know that only works for a short period of time, because once bad policy creeps in, then it's just a matter of time until somebody attacks it because it's unsustainable. But if you're floating them, there's a lot of variables that go into the equation. Me, that's what I love. You know, I love complicated puzzles. So that works.
But if you put rates at zero, you've got nothing else to lever.
Yeah, so you better, right. And which has made it difficult for guys like Tudor, you know, and Kovner.
Oh, yeah, absolutely.
Yeah, because, you know, the fundamental analysis that we want to do and engage in is much harder in this environment, because we've never seen this. We have never seen this, and it really play out. And so that's
why, I mean, I've been very selfish in taking most of the platform's time tonight, which is why. So I love your view on the dollar, because your view is it must happen, because if it doesn't happen, it's bad. Is that a fair?
Yes. And along that, you guys, as you guys have been talking, the beans have been rallying, the corn's been rallying, the cattle's been rallying, the copper's rallying. Go ahead.
So is that a fair assessment, Ira, that if they don't weaken the dollar, it's
absolutely. You've got it. You've got it covered. And now Richard, he must be listening to this conversation, because he just sent me, you know, Bernard's new book is You Always Hurt the One You Love, you know, how central banks have destroyed capitalism. But, and Bernard's been maintaining that since Greenspan, you know, was in the driver's seat, because he thought Greenspan was always well-intentioned. It's just that the outcomes from his policies were going to absolutely be very harmful. And the Greenspan put has been very destructive of global capitalism, by the way.
As smart as you are, and I know you are, you're off the chart smart. That's a conflict with Lacey Hunt, because Lacey Hunt's view is that I don't think that's going to happen. I think Lacey's view is that, and I agree with you. Of course they need it to weaken, but all these people, when they started with all these experiments about QE 1, 2, 3, 4, S&B buying Apple, through, you know, all that, no one ever thought that this would start. It all kind of started with the LTCM, or maybe even started when Greenspan got the seat in '87 and didn't like the market going down.
Yeah.
I mean, now we're here after all these experiments and all this stuff. But Lacey Hunt says the dollar still will go strong. Is there still a deflationary fear in some part of your portfolio?
No. Well, yes, because gold is, to me, the ultimate hedge against deflation. And I know that flies in the face. That's the argument they always have.
Exactly. I agree.
Right? Because it's not the deflation. It's what central banks do in response. Because if you accept the premise that they're all 37ers, once they followed Bernanke down the rabbit hole, so to speak,
yeah,
37ers are all tied into that. So if your fear is fighting deflation, I'm going to ride that wave. And it tells me that gold is the only sustainable store of value. Again, when you have currencies, especially in a fiat currency world, there's nothing standing beyond the value of a currency than the full, as we say, the full faith and credit of the United States government. But that's predicated upon responsible policy, okay? Both fiscal and monetary. Once that become unhinged and unanchored, now you're floating in the ether world, and a currency by definition does two things. It's a store of value and the medium of exchange.
Absolutely, agree.
Right? The Fed is in full battle mode to destroy both. And when I say medium of exchange, yeah, you may make it a medium of exchange, but if you go to electronic currency, to me, the definition of a currency has changed dramatically. It's no longer a medium of exchange because they can force your hand by, once you go to electronic money, and people should have to think about this, and I've read lots of it because there's, Larry Summers is has written about it. Rogoff is on the, because once I go to electronic money, I can go to negative interest rates of 5%, 7%. I am going to force you to spend what you have because, again, I'm going to battle the paradox of thrift. See, Lacey would probably tell you that savings will overwhelm because, whether we use Ricardian definitions, and I'm sorry if I'm getting pedantic here, but there's no other way to deal with this, by the way. You must delve into economic history and ferret these things out. So I apologize if people's eyes are glossing over, but there's really, these are the way you have to look at this. So if see, for Lacey, savings increases because of the uncertainty that people will save more because they're just so uncertain about the future. Well, that becomes Keynes's paradox of thrift. So how do they break that? They can break it by going to electronic money, but that takes us again to that whole concept of negative interest rates. And that's why I'm pretty sure, as much as they at the Fed, and there's so many things they hate about it because it hasn't worked, but when they panic, I think it won't be yield curve control. I think they go to negative interest rates for that reason.
So I agree with you, and I think they've got it right. And well, I don't agree they got it right. I think they fucked up, but we have to we trade the plan, not what we wish they did. But I will ask you one question.
Yep.
And it plays in my mind all the time.
Yes.
And it's a weekend risk every weekend because geopolitics is now is part of our financial reality. So if Ira,
yes,
every central bank in the world never thought they would have to fight deflation from 0%, did they? When they started QE 1 or 2 or 3 or 5, they didn't. They started at 5 or 6%. They never thought they'd have to fight it from 0 or negative, and that was always the problem. Now we're in geopolitical war. There is a country that doesn't like us anymore. Australians and Americans. We're allies forever. What if one Sunday China moved on Taiwan and devalued the currency and then exported a devaluation on the world? Do you think the market would be up 10% or down 20%?
Yeah, you know what? It's a very good question. And if you reading my blog, I've always said Hong Kong's a sideshow. It's always been Taiwan, always since 1972 when Nixon went to China. It's always been Taiwan, and that was like one of the things that irritated me when Niall Ferguson interviewed Kissinger about 7-8 months ago. A year, I don't know, my timeline's a little screwed up, after when Hong Kong erupted. And not one question did he ask about Taiwan. And I thought that was so disingenuous. And I'm a big Niall Ferguson fan. I'm not a big Kissinger fan for various reasons. I'm a child of anti-war demonstrations. And up until probably 1985, I wore a button on my jacket. It said, Allende sí, Junta no. So I'm not a Kissinger fan. never have been, never will be. So it's always Taiwan. It will always be Taiwan because when China really wants to rattle the cages, that's the vulnerable point. And the question that I would ask Henry Kissinger if he was sitting here, and it's the question that they were asking in 72, which is, will the US risk thermonuclear war to keep Taiwan independent? That's the geopolitical question. Would you risk thermonuclear war? It's the same thing I ask about NATO and why Trump wasn't wrong about NATO. He's just a terrible messenger. But what is Turkey doing in NATO, as long as we're on the geopolitical track? Because they haven't lived up to their agreements. In fact, go back to the Iraq War of 2003, when they didn't let the Fourth Army come through Turkey. So, and Turkey's in all kinds of other violations. So why? Because the collective action clause that's embedded in NATO with the United States, if Russia and Turkey went to war, which by the way is historically, has great historical ramifications, and Erdogan being Erdogan, but if there was a war, would the United States risk nuclear war to save Turkey? You know, if you're not asking these questions, you're not really, you don't really want real answers. But these are questions, and these are the questions that journalists should be asking the powerful.
Steve, Ira, Stephen just dropped in a thing. He said, think of Taiwan like Hawaii, an unsinkable aircraft carrier off the coast. It's a strategic military asset that China will ultimately not be willing to let go.
Yeah, I think there's no question. And see, people don't understand. In 1957, you know, the Chinese used to, back in the 50s, used to fire artillery across the Taiwan Straits regularly. Quemoy and Matsu, go look it up. It's the same that people don't really realize that India and China in 1962 fought a massive border war where they're now, you know, where the conflict, these are not new. That's why when I see them pop up, I don't pay much attention to them because they've been around. These are not new things. There's not, you know, but why don't these questions get asked? And it's the same here. I'm reading today about Iran and China making some type of trade deal. And I go, wait a minute. The United States is sanctioning China over Xinjiang and the Uyghurs, and Iran, who is by their own accord the great protector of the Islamic faith around the world, is busy doing business with China? Excuse me, why? At least ask the question. What, you know, these things, this is where, and I'm not bringing this up to be political. This is where money is made, because it's in looking at these things through that type of eye that has been my, again, as we talk about, that's what gives me the ability to provide context and understand the nuance of events.
Well, I would actually agree with you on that, because on the basis, if the goal to the yuan or the Chinese currency is making new highs, which it has, and closing every day in trend and seasonally strong, it supports all that thesis just on technical. Now, I guess I just say to anyone that if you're trading at the moment, you need to ensure you have liquidity
Yes.
and don't have exposure on the weekends.
Well, the exposure on the, you know, see, I don't really worry so much, Andrew, about geopolitical events, because my view, and actually how
No, I'm comfortable long gold, long China.
Yeah, right. But when I say that, because Howard and I had massive discussions, because we realized that every time we would buy gold on a breakout of some geopolitical event, it had about 3 hours of longevity, and then it wound back on you, and every turned into a bad trade.
Well,
Because it stayed too long.
Eric just made a good point here. Uyghurs are Sunni and Iran is Shia.
Yeah.
Oh, that is a good point. Yeah, I see.
Very good
Again,
point.
but if you don't discuss it, you don't get to that point.
Yeah.
Correct.
Well, that's what's great about
Yeah.
having a lot of mental horsepower in the room.
Yeah, absolutely. Because if you don't get there, you're never going to get there. But it's it's a point worth entertaining. So Hunt thinks, and they're in that camp of the dollar short. Let's come back to that premise that the dollar shortage is going to prevail because of all this debt overhang that has to be financed. And I was there originally, but I have turned.
No, I'm not. No, I'm not the. I'm motivated by price, 100%. So
Yeah.
if I see the dollar weaken, and it continues to weaken, and by Friday get this, the confirmation of the stuff we spoke about today,
Mhm.
I'll look at the trade as a rotation. But if
I agree with you. I agree.
but if I look at if we get the reversals by Friday and I start seeing the Aussie get weak, I get concerned about deflation. I get to Lacey's camp, and I start looking at the bonds and short durations. I don't want to loan anything beyond 2 years because I don't want I can see it going down, and you can make a lot of money in a short duration.
But you're seeing it right now, Andrew. I mean, they're buying the bonds, they're buying the grains, they're buying the meat.
But I need the copper to go. I need to see the currencies behave. Now, Ira's view is I accept it fundamentally, but if I get technical confirmation, it's one of the most profound things you see. If it happens, I'm going to look for this like a hunter. I will hunt this fucker, and if I see some vol, I'm not a vol trader, but the Russell rally this week, Ira.
Yeah.
Rally with higher vol. I'm not a vol trader. I've never bought a vol in my life. But I do know vol. You don't want vol going up when the market goes up. It's disconcerting. So it looked bad to me. So but if I get that 20-year event, I'll pay attention next week.
Yeah, no, listen, Andrew, I'm a trader.
I know you are.
I have to sustain myself, and so I'm not locking up with Lacey. We have a different view as to the time duration of when this plays out. But if I were to see the dollar start to rally here in a meaningful way, it would the dollar is an important element because it would signal to me that we are now seeing the deflationary forces set.
Hey, you've been right on the dollar. It's been a good, but if it changes, what do you think?
Oh, I will go back to a late February, early March.
I love the fact that you have that flexibility, and that's the only way anyone survives in this business.
Well, you want to take a look at all these European debt markets right now because they are all putting in bullish patterns. Big time. The Bonos, the Oats, the Italians, the gold's starting to pick up with it. So is the silver, the copper's gone, and all the commodities are all on fire with a rally in euro.
I will tell the floor. I mean, this man was very generous. Took me down the CME floor as director, and I think you still are, aren't you?
No, they voted me off the ship.
And thank you for that. I borrowed too much time, but it was an amazing conversation. All right, thank you very much.
Well, listen, it's only because everybody pushes it out, and that's what I keep stressing here. As you could tell this room, this is what good funds do. The Soros Fund, they have conversations every
I
morning.
assure, I work for a very good firm like Tudor. Mate, they're not that good, by the way.
Yeah, I know.
You can be very good in your own right.
No, it's nice of you to say, but I've seen enough of it, and I work with Owen
No,
Brown.
you're the best, but I'm saying the rest.
You know Owen Brown?
No, I don't know.
He was at Bankers Trust when it was really Bankers Trust. He was at Chase, and I worked with him. He ran a firm, Solaris Capital. So I moved to New York for a couple of years with him. But when
Wow.
we were at the top of our game, we had these hour discussions every morning, and where we would ferret out, well, are we still on this idea? Do you think this still has merit? And it was the compilation of the other two people who worked with us, that, hey, so you're not going to see everything. And as a matter of fact, people, what they don't understand, these are not for about validation. These are to ferret out good ideas. Validation the market will bring to you. I don't need, that's where people get off they don't, I don't need validation. I don't need validation in what I say to Santelli. I need validation in what I write down. I want to generate a discussion as to why I could be wrong, because there's not a trade that I don't embark on that I don't think is wrong.
Well, can I see?
How can I see?
Can I ask you a question, right? Because you're a seasoned guy, you made your life trading, right? But when people hear your voice, all right, and you say something, they think what you say, that trade is right. Now, that's not how a trade works, right?
Right. Oh, yeah, absolutely.
You got a portfolio, right? You got equities, you got commodities, you got currencies, you got rates, and it's almost impossible to teach that unless you are part of that. Does that make sense?
Yeah, that's right. That's exactly right. And you know what? That's what I really miss most about the floor, because I could walk onto the floor and I can have untold discussions with people who I respected, whether they were actually traders or were, handled phones, but they were very, and talked to. So there was an easy access to that conversation. The machine has actually destroyed that. And you know what? I was aware of that 20 years ago as electronic trading really started to take off. And I said, there's really a need for a place for this conversation to take place. And people don't realize how valuable this is, because you're not in the trading business, you're in the information business. This is a transference of information. And as I say, your opinions are worthless to me unless we can generate good investments and trades out of them. It's all gibberish. I don't care what's written on the pages of the New York Times. Meaningless. If I can't take it, that's my mercenary. Had I been more mercenary in my time with Paul, I would have still been with Paul, because we had a great relationship. Him and Peter. Peter, I still every once in a while I'll talk to Peter. That's how nice the relationship was. But it's a very mercenary outlook, because that's what my business is. My political opinions, as I write in the blog, if you think I'm being political, you've misconstrued, or I've written badly. It's because you should not know my view whatsoever. It's because I don't care about opinions, those political opinions. I care about taking concepts and putting them into an investable idea that can generate income and possibility. Now,
I have one last question for you.
Wait, but let me. This is
Please
very fortuitous, because I'm on the FT site, and lo and behold, there just popped up an article that I just saw. The IMF should turn to special drawing rights in its COVID-19 response, and it's written by Yi Gang, who's the head of he's the governor of the People's Bank of China. So I haven't read it yet. I will get to it, but I'm calling your eyes to that. Okay. One last question, Andrew, and then I'm.
One last question, and we give it back to Judd, and I apologize for taking the time of the floor.
No, this is why we're here, Andrew. I mean, you
My
know,
question,
I've been putting up charts for all the short-term guys to see what I'm looking at as we've been talking. They can see the rotation. It's been into industrials, you know, commodities, whatever. And this is everything we've been talking about. It's the European debt. They can see that flow while I'm putting it up while you guys are having these conversations. But this is the kind of stuff that we love because it gives us deeper trades and conviction.
And Andrew, when you look around the board, and as Judd brings up the European debt instruments, the euro is rallying with yields dropping, right?
well, the guy, look, you know, I'm a, you know, God, 30-year veteran, and I am still fucking learning. And I'll say, my question is to you, sir, because, you know, I do consider you a sir.
I've been knighted.
My question is, do you think do you think it's easier do you think it's harder to trade now than it was before? Do you think today, because everyone goes, you know, there's this Robin Hood and stuff, and back in the day you could read, you know, and you know, you could look at a yield curve to see what a currency could do and all that stuff. Do you think it's harder to trade now than before, or do you think people are lazier and it's still the same? All right.
Okay. This is a big question. This is my existential question. And I think that the titans that you know in the global macro world have dealt with this and tried to answer this and played with the way that they approach markets. You had Tudor, who went from doing analysis exactly like we're sitting here doing now to then going algorithmic, and that didn't work out. Now, I will say this. What's made it harder is the algorithms, because the algorithms are last tick price sensitive as far as I know. You know, of course, it's a way you program them, but I really believe that they're devoid of fundamental analysis on a moment to moment, and their ability of speed, which means more than anything, made the traditional way that I would trade on a momentum basis, you know, where I really thought I had the bit in my mouth and I was really on a trade. No, that didn't work with the algorithms being that. First of all, they were deconstructing everybody's work, you know, and I think, and I have great respect for Dennis Gartner. Dennis and I go back a long way. And I think that Dennis didn't serve himself well by really announcing in his letter how he set his stops, because I believe that the algorithms deconstructed his work and it was easy to go after him. Because Dennis is still a high quality thinker in the global macro world, one of the best.
I asked the question. That's fascinating because he became way too public to you. Is that
right?
He was vilified.
Yes. Oh yeah. Zero hedge. He was zero hedge punching bag, and so wrong.
You regard Dennis as a good trader?
No, I don't think Dennis is a good trader. I think Dennis is a great analyst.
Yeah, and that's a great distinction, Ira.
Yeah, and an okay trader, because when you get it right, it's like when he got on the gold euro, and I was on the gold currencies right along with him even before, because I can tell you, going back when I got on the gold euro as a big precursor of what was going to come was off of that. And I did a lot of work with my friend, Mr. G. And back in 2001, when the gold euro broke out of a long-term trend line at 320 euros and then 360 euros to an ounce of gold, that was really an important time for gold.
What year was that?
I think 2001. I could be off.
That was I was talking to Andrew about that. That's when Howard called me up and said that the PM fix had broken out on the 20-year point and figure.
That was off that gold euro, by the way. I remember that so well. You know, we had, oh God, hours of discussion. My wife was yelling at me, get off the goddamn phone array. But that was very in-depth. So Andrew, I think the algorithms really being devoid of fundamental analysis in the way that I approach it taught me to relearn and to be patient. So as you know, as I've discussed with people in this room, you know, I'll put it, last night's copper order was a wish order for me. I was buying, you know, 9-10 cents lower than where I was really starting to like it, but I put it in and I said, okay, if I get filled, I get filled. I have euro orders in right now, just in case a headline comes out the year, you know, because I know they're meeting tomorrow and Saturday. And if somebody leaks out a thing, probably through Reuters, that things aren't going well, the euro will get hit. I'm a buyer down there because I have to test now what was resistance is support. So that's a wish order for me. And I'm not involved in the euro right now. I was going to buy it this morning when I got up because the euro was trading 95 to even when I got up because I'm still on an Arizona time, you know, and my sleep patterns are really screwed up. But it's okay. It's actually working well. So I am, Andrew, I'm 67 years old and I've learned patience. You know, one of the...
You have what patience?
Yeah, I have much more patience. So, and even though I've been trading off the floor very effectively for, you know, close to 35 years, as well as being on the floor, but for different reasons. But one of the diseases of being a floor trader is you have to be in action. Because what's the sense you standing there for? So hitting the button.
That's a fascinating thing because I've never been a floor trader. So when you say that, is that energy? You mean you need the energy to feel it?
No, I'm sitting in front of the screen. Oh yeah, that's a good level, but it's not a good level. I have nothing there, but you make the trade anyway, and you go, that's pretty stupid. That was like the
trade. But you can have an opinion the euro goes to 140, but you can be in and out on the way through.
Right.
That's what you.
Right. You know.
And the only way to make money is to be in and out. You can't sit with it all the time.
No, and you know what? And I look at levels, and you know what?
Exactly right. No, yeah, exactly right.
Because the algorithms, it's like, look at, they knew, I speak of them, they were programmed to know that 113.35 for 4 or 5 weeks already, that 200-week moving average, which correlated, by the way, with the 200-week moving average in the dollar index, were significant numbers. And they gave us, so when I was, if I'm trading well, I'm getting out and I'll be willing to risk 20 or 30 ticks by Friday's close to get back in the trade. But it really gave me some good opportunities to trade it. And I was very vocal about it. And it would correct. Are we going to get another correction here? Don't know. I'm thinking that we are because I'm going to let the algos do the work. And you know what? The best part about being patient is the algos that are set up, and I've seen this now for 15 years, that are set up to be keyworded to headlines will do the work for you, because that's why on Fed days and on unemployment, if certain keywords show up in the headlines, and believe me, this will take us to another, and I'm not going there, but I can have hours discussion about what the regulators should be doing as far as who owns some of these news services that we never saw before in our lives, but they write headlines that are keyworded to create volatility, but have no basis in the substance of what is really being reported. And they create not as much as before. So it tells me that some of these algos have been shut down, or some of these high frequency trading shops, because we're not seeing it like we used to. But for quite a while, I would read the headlines, and then I'd see the substance of the story. I go, the headlines have nothing to do with the substance of the story. Here, Lagarde's, actually the markets were pretty well behaved today, because Lagarde's press conference, which I listened to from beginning to end, kind of was devoid. But she's more clever than Draghi was. Because she's a lawyer, and as she likes to say, she's an owl. And I was not a Lagarde fan to begin with, but I turned quickly, and Santelli, I did it on his show. He said, wow, you did a 180. I said, yeah, she's earned that respect. Now she definitely knows where she's going and how to get there. And she's going to be, and she's, I think, absolutely doing a great job in a very difficult situation. And not because she's gotten the liquidity, but because she's going to get that Euro bond done with fiscal harmonization of some sort. That's the key, as well as, of course, some type of European-wide.
Is that why you pushed the euro?
Yeah, well, that came really because I knew she was successful when Schweibel turned back in May. That was that's what got me the bullish of the euro, because I said, well, there's no existential threat and I don't like the dollar, but I needed an alternative to the dollar. And the Chinese yuan is not an alternative at just junction.
But gold is, though.
Well, gold can never really be again, unless how you're going to price it. So yeah, if you take, then you get into the crazy camp and you go $10,000 an ounce, because in order to soak up all the,
Why can't gold be at $10,000?
Gold will have a place as long as central banks and government policy is irresponsible. That's my only point with gold. Go, believe me, and people say you're a gold bug. I said, no, I wish gold was $41.25 an ounce. But the poor fiduciary responsibility of governments has made gold much more valuable, because people have to seek some store of value. Fiat currencies do not provide historically a high quality. I mean, they go through periods, when they're beloved and they're doing things right, but they're not historically a great store of value over time. And but this is where we sit. And again, patience is due, because the algorithms will drive level. Look at case in point yesterday. Judd, this room, as you kept, chatting with me, caught the bottom. It hit some levels, caught the top up at that 31 and a quarter area, which I sold it against last night, by the way. I sold 25s, 26, and 27s in the S&Ps last night against some certain things, against that 31. I have the level here on that pivot. I'm sorry. 32.31.
Yeah, and it was yesterday it was a perfect low, because they gave you the spot. I mean, Jeff sold them before the opening, and he covered them at the gap fill in the pit. And that's why, it's nice to keep up both sets of charts, because the pit charts can give you a tip off to some really good trades. And everybody else doesn't have them, because if you're on anybody else's platform, they're giving you garbage data.
Well, and the essence is to be patient for those. They're going to come, because the algos will drive them. They are not fundamentally driven. They're headline driven based on some, but once you get to the substance of it, and that's what I think some of the big global macro guys from Druckenmiller, who's one of the greatest, Kovner, great, but they struggle a little bit because they do fundamental analysis, and the algorithms were mathematically inclined to last price predominantly and could really shake and bake you. And, global macro guys like myself, and believe me, I'm not putting myself in their camp at all, but only in the thought process of it. We need wind in our sails. They need wind in their sails to really get going. That's how they traded. All the great trades only happen once they start making money. They get very, very aggressive, and you haven't seen that aggressiveness from them.
Well, I think you don't give yourself enough credit, Ira. You could have been in those shops. Wonderful conversation. I've enjoyed it. So thank you.
And this again too goes back to the Steve Drobny, book Inside the House of Money, which I was so happy to be selected to be part of that project. But go read those global macro guys. I don't have the book here. I have it in Arizona.
I agree.
But I will also tell you this, okay? For, as we say, I have that sitting in front of me. There's a CME magazine that was done in the spring of 2007. I'm sure you can find it online, in which they do an interview with Steve Drobny, because his book had just come out, or the year before, on Inside the House of Money, and Bernard Connolly. Go read the Bernard Connolly in 2007 spring. You'd think you're reading it today. Go find it. I'm sure you can find it. I have the hard copy, which I was just reading it because I've been cleaning out my house as we're going to put the house for sale. So I've been cleaning out all kinds of things, and I find unbelievably good stuff. But that's global macro. Be patient. And you know what, Judd? I can't tell this room. Langer is to be applauded. See, because he comes up with a level like 84.50 in the copper. You're patient. You got it. Because the algos drive it to you. They get on that search and they just blah, 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 blah. And if you're there to pick up the pieces,
Amazing.
you can get on. And okay, even if you're wrong, you're now in at such a low risk profile. Give me those trades. I'll take 20 of those trades a day, and I'll be wrong 20 times. But for that low risk profile, I'm in. I'm in. I can be afforded. It's not like, you know, when you're a stupid floor trader who has no location and is just trading to trade, you're just vulnerable for the world collapsing upon you. That's not, so in order for, so I'm answering your question, Andrew, it's harder to trade, but if you're patient, you can get an edge like you've never had before.
And that's it's a great answer, because ultimately what you're saying is that the fundamentals don't change, but the volatility has.
Well, the market's desire to read them is changed. You know what I mean? We used to.
But if you're patient and you sit in your pocket, you'll get your price.
You got to win. You can't trade in the middle.
I can tell you, Andrew, 25 years ago, you would talk to Mr. G, get your levels, and then you would have 3 or 4 phone conversations about things potentially coming off the Reuters or Telerate machine that were driving the markets. When, you know, when trade figures reign supreme, far more important than unemployment number. When I can go back when the Fed used to do repos, reverse repos.
But I love your response. Well, in essence, you're saying nothing's fucking changed.
No, it's not. It's just the speed. I want to slow myself down in a world that wants to speed me up. And when I find when I put
but if you're a young man, nothing's changed.
No, and the world, how many opportunities in a day do you need?
Exactly right. I love that response. I love that.
Okay, now I pulled out a paper before, as I said, okay? And this fits very well with Yi Gang's piece. But this came out, I have it only because I've been promoting the concept of use of gold by the IMF for probably 20 years. But in September of 2012, which is an interesting date anyway, because it's after Draghi's famous whatever it takes speech, the European Parliament put out a piece a more effective Euro area monetary policy than what Draghi had proposed in outright monetary transactions. Okay, that's the title of this. A more effective Euro area monetary policy than OMTs, and subtitled Back Sovereign Debt. If you can get a hold of this from the European Parliament site, it's worth, Andrew, you'll love this. You'll oh my God. But
Yeah, I'm listening.
a phenomenal piece. And I bring it up only because I believe we are going to get into this discussion as we move forward here. Because they're going to look for ways to monetize, you know, especially in today's world. I'm surprised the IMF hasn't done it to other countries. And I think that's where China is ultimately going to go, by the way. China will have a gold-backed instrument, not one-to-one, but in the world of securitization. Would I buy a Chinese bond yielding 2% if it had 20% gold backing? Absolutely. It's far better than buying the bond of the United States government with the full faith and integrity of the United States government, because I believe in neither. I have to live within it, but they haven't shown me that they're a fiduciary of a high quality. So with
you're one of the best geopolitical macro guys I've ever read and seen and known. And I still will ask the same question. If I was whatever, why wouldn't I just devalue the currency now and move on Taiwan and deflate the economy? And that's the best war act on the world to them. So why not be short the yuan and long the gold?
Well, I believe me, people are doing it unless, see, the only reversal you run is if the Chinese are going to do, just like the Russians. You know, the Russians are moving away from dollars in a big way. And you say, well, it's the Russians.
Yep, I agree with that, yeah.
But, you know, always see that, and this.
And can you answer that? Because, you know, why wouldn't he not do that?
I'm gonna answer it, you know, I'm a capitalist.
Yep.
If you're a capitalist, you understand that prices are set at the margin. For me, geopolitics and my understanding of global macro really takes place at the margins.
Yeah.
I don't care what the New York Times reports on any given day, because that's what gets spoon-fed to everybody. Because everybody who works for the New York Times, you know, the whole essence, and it's the same with CNBC, everybody wants access to the powerful. Well, that only tells me what the status quo is. I can't live in the status quo. Never in my entire life. I have been on an outlier thinker as long as I've been able to, you know, to put a paragraph together. It's just the way, it's just the way I'm wired. Anybody who's known me, it's like how I could come up with the S&P bond. You know, I think on the edges, because to me, the edges are far more interesting. I know what the mainstream thought is.
100%. That's beautiful what you think that way. Beautiful.
I mean, I can only think, I'll tell you what, I locked it with John Richards, and it was a mistake. And John and I would, if he was here, he'd laugh at it. He'd laugh with me. Because in 2000, when the Aussie dollar went down to what, 57 cents, 56 cents?
Hold on.
When was that?
Yeah, it went down to 52 at one point.
Yeah. What year was that? It was right around there.
Oh, God. That was around 99, I think, 2001.
2001, right. So I called him up, and I said, JR, look, you're my guy.
47.76.
I was begging.
In Australia, I couldn't travel anywhere because it was so hard, because it's expensive to go overseas.
I was begging him to buy property in Brisbane. I said, let's just buy apartment buildings. It's so friggin' cheap. What's the difference? You know, if you're getting paid, he was getting paid in dollars, US dollars. I said, he talked me out. He said, hey, it's shit. I go, well, I never, and it's not him, because I have a lot of respect for John, which is why I even asked him. But that was, you know, that was on me, because that's the plays where people like Sam Zell and Icon, that's where they look for those opportunities. It's like why people are going into Europe now. And everybody wants to talk you off Europe. But meanwhile, guys like Icon and KKR and Apollo, they have funds, Blackstone, all denominated in euros, trying to, you know, buy out distressed properties and debt and businesses in Europe, because they've been under invested for a long, long time. And they have dedicated funds. That's why, you know, and it's also, you know, I was waiting for what could turn the euro.
Ira, I think you're giving an education here, which it's taken me years to think about. I mean, if you live in a currency, you have a domicile, right? So if your currency and all your assets are in that currency, you weaken if that currency goes down in your purchasing power, right?
Yeah.
And that's monetary policy in by definition. You know, that's what the banks do. And that's what
of course they do. They here, I have the piece you weren't on yesterday, but the speech that Thomas Jordan gave, you know, from the Swiss National Bank the other day, which
man, when I was when I was living in Australia, which I do, 2 months ago, my purchasing power globally was down by 20%.
Yeah. Well, but that's a deflationary aspect on the globe, right? And
Indeed.
believe me,
Indeed.
if you want to go into a deflationary spiral, and I've had this discussion quite a bit. You know, when Bass and all those guys and Druckenmiller looking for a major depreciation in the yuan, I think it was back in February of 2016, and I was on with Santelli, and he asked me about it. I said, look, if you think that's going to happen, I wouldn't trade yuan because I'm too vulnerable to China. I said, if you think that's going to happen, though, just buy bonds and buy gold. He said, buy bonds and buy gold. I said, yeah, because you're going into a massive deflation. Because if China depreciates the yuan, at that time, I think the yuan was trading 6.50, and they were talking about it going up to maybe 7.5. And everybody was getting sure. It was over a weekend. And I said, you may as well just buy bonds and buy gold, because China will unleash a wave of deflationary pressure on the world.
Well, I think they may still do that.
Well, they might. They might. Listen, that's a great point, Andrew, because again, when a lot of people do their analysis, the way they go about it is they assume a static response.
I agree with that.
Right? Markets are anything but, if you know, and that's my problem with a lot of these models, they're too static. Why do you think it's going to be a static response? Why is it that you don't think that these people are capable? Here, classic case of Russia, you know, sanctions on Nord Stream 2. You think Russia's just, the United States says, you know, we don't want you to do that. They're going to just sit there? Not in any world that I live in. So I look, again, on the margins to look for those dynamic responses. Absolutely dynamic responses. I look to see the things that are going on. And this will be the last thing we talk about, and then I'm going to get off. And Judd, I think you'll remember this. I did a Credelli, Anthony Credelli, who's one of my favorites, in October of 2016 with Santelli.
It was 17.
No, 16.
16?
Yeah, it was before the election. So we did an hour and 20-minute live podcast.
Oh, was that a Top Step?
And where?
That was the one at Top Step, or was that a different one?
Yeah. No, not a Top Step, but they got the CME Top Step and O'Brien, I think, and RJ O'Brien sponsored it. And it was held at maybe it was at Top Step, right. So we did an hour and 20 minutes, and then we discussed the energy markets. And everybody was bearish oil. I said, I see the supply demand numbers. And oil, I think, was trading like $45. What's her name? Who's really good? Not Anne Marie, but Shy Gal, or Shy. She's
the
really
Shy
good.
Girl. Yeah, she was an oil trader.
Yeah, oil trader. And everybody's bearish. I said, I'm not bearish. And Credelli goes, huh? I go, no, I see that. But something happened prior, which is that the Saudi king went to Moscow about 6 weeks earlier. And actually, Art Cashin and I'm not name dropping, I'm just telling you the facts. He picked it up in his letter because I wrote about it in the blog, and Art and I have great respect for him. It is a font of wisdom, especially about floor activity. And I said, this is the first time in history that a Saudi king has gone to Russia. They didn't go to just talk about, in my mind, that they were looking at ways to prop up oil, and that the Saudis would capitulate with the Russians because the Russians were in full control of things happening in Syria, and the Saudis knew they had to live with the Russians. So I said, that keeps you from being bearish oil. And oil actually went right to $62, $63 because Russians and Saudis were playing with the market. So again, what got me to see that? Because I'm looking on the margins. I'm not looking at the headlines reported in the New York Times or the Washington Post. Yeah, that's nice, but that's not the way I can make money in the investment world. Again, I'm a capitalist. I look at the margins. Now, if there's nothing there and all I'm seeing is certain momentum, but things don't drop out of the sky. Things just don't happen. That's my point. The markets are way too dynamic. The world is way too dynamic. If you only approach the world with an American-centric view, you're going to get lost. I'm sorry. You can worship at the feet of the Fed. I don't. They make nothing but mistakes. The U.S. Treasury, there has not been a Treasury Secretary I have respect for probably since, oh my God. Dare I say Bob Rubin, but that waned quickly too. It's been, none of them I think are any good. So what do I want to listen to them for? And it's all based on, again, well, the Americans run the world. You know, the Tom Friedman, the world is flat. Yeah, nonsense. Nonsense. The world is far more dynamic. And that's all I'm going to leave you with. And we'll have another.
I agree with you, sir.
So
I've enjoyed the conversation, gentlemen.
okay. Well, let me tell you what, it only took place because you prompted it. Because this, you know what, this is what makes this room so important. And you can say, you know, Ira, you're full of shit. Great. I'll send you your check back. Don't listen. Don't listen. But
look,
here.
What I would love about this room is that let's see where the Friday closes happen, and we trade to make money, right? And
exactly.
Who knows where Friday is? If Friday is devastating for the patterns that may occur, what do you think about next week?
Yeah, you know what?
Here we are, Andrew. I mean, the Nasdaq bonds are hanging under the weekly ORL. They're right there again.
Yeah, and these are such, you know what? And again, the S&P DAX is turned down under the, I don't know, I haven't looked at it yet.
It's been under the 200-day all day. And
okay.
Just been
I hate to tell an old timer, but mate, have a look at if this happens, let's shake it off. It's
right. Exactly the way to go about it, Andrew. Exactly. Here, and one of the great, you lead me to one more point, and has been really good about doing this. But Howie and I, on a run, and the story is well known. I was out on a run on the lake for my lunch hour, and I'm having a concept. This is back in the early '90s, maybe late '80s, about the relationship of S&Ps to bonds, U.S. bonds, 30-year. And I said, equity values can't exist in the netherworld untethered to anything. They always have to be related to interest rates because the cost of borrowing money is what drives entrepreneurial spirits. I said, so I stopped at the North Avenue phone. And I called Howard Collect. I said, you know, I'm thinking about this, He says, okay, let me, and you know, he loves a project and he took it apart and I applaud him. He did phenomenal work. He found that there was indeed a really nice technical relationship that existed. And that chart over the last 25 years has been a warning signal as much as anything. And over the last 3 years, it's enabled us to catch some significant moves. And you know what? You want to lock up with me? Great. Go read the blog. In October of 2017, when that finally made a new high from December of 1999, that chart, and Judd could show it to you, it finally closed the quarter on a new high in like 1635 on that relationship, and it led to a 30% straight move.
Yeah.
And then the following October, which became the famous fourth quarter of, you know, the double shotgun approach to tightening QT and raising rates. And we said, and I wrote a blog and Judd picked it up and talked about it. I said, this has gone too far, too fast. This is parabolic. and we got a massive correction. And even in the height of the COVID, corrected to in the way it traded, and it's still trading with a significant view as to where we're going here. So, again, just thinking on the margins. Yeah, that doesn't mean being wacko, but respecting the dynamicism, capitalism in markets.
And look how equidistant the trades were off the spreads when it failed to double top and 18 to 20.
Yeah.
It came down below that breakout and did a whole equidistant swing all the way back down to the lows in the S&Ps before it came all the way back up. I mean, it's incredible.
I love it. I love the way the spread bar works. I've been on Bloomberg for a long time, and you can't get that on CQG. So it's a great picture.
Yeah. One of the problems, no question about it. It's more than a fair point. But this conversation, look at where we went with this, and I hope people found value in it.
Well, I mean, I found it valuable, and thank you, Ira. It's always great it's been great to reconnect, and going well, and looking forward to being part of this team. So
and the more people, if we had this room filled up with 500 people who could add something on any given day into the conversation, good. And it doesn't have to be, in agreement. In fact, if it's in disagreements, it's even better. Here, you and I.
I agree. Well, I agree. Let's get Lacey Hunt on.
Who?
Okay.
I didn't hear that. What did Andrew say?
Let's get Lacey Hunt on.
Oh, yeah. How great would that be?
Amazing.
And you heard it in that podcast, where we agreed. Listen, I locked up with David Rosenberg. I have a lot of respect for David Rosenberg, but I always thought he was a little too negative on certain. Although it was funny because when we did that, what I called the Four Horsemen of the Apocalypse, we did that podcast with Bianco Bookvar, myself. Bianco said to Rosenberg, he said, "Oh, you're probably the most optimistic out of this group at the time." So, I told Jimmy, I said, "Wow, you were." He says, "Well, it was probably true at that time." I said, "Yeah, you're right. That's true." Well, thanks for entertaining me.
Thanks for coming in, and Andrew, thanks for your participation.
Andrew.
Take care, guys. Take care.
Thank
you, Ira. Thank you, Judd.
Thank you. Yep.